these valuations are grounded in like what customers are actually paying, or is it some of it the market kind of pricing a story ahead of the numbers in a sense?
Oh, it's certainly a market pricing a story well ahead of numbers. And I think that those are always dangerous games. I think many founders, they think that, oh, I'll just spend all this money and the product market fit will come.
The growth doesn't necessarily mean headcount and salaries. It means they want you to grow more market share, more revenue, more customer base, etc. Like, how do you think of that?
The most important fact that just growing, having more social media presence, getting more likes in your posts, having more followers, getting more events, going to speak at more conferences, none of that matters.
There's a double-edged sword to that, as you said, like cautioning that. Like, what could it mean if you don't grow into that valuation, or it doesn't go the way you want it to go? Like, what does that truly mean for the founder, the team, those kind of things? What does that mean?
One of the easiest unfortunate ways to destroy a company is to have a down round. I mean, we could just give the money and say, go and spend it in these 6 areas and this will work. Yeah, unfortunately, it doesn't work that way.
Thank you for joining the Resilient Cyber Show. My name is Chris Hughes, and today I'm joined by my friend Sid Trivedi. Sid, thanks for being here.
Thank you, Chris. Thanks for having me on.
Yes, it's kind of turning into, I guess, an annual thing. I had you on about last year around this time, heading into to Black Hat or Hacker Summer Camp, as people call it. But, for folks that don't know you, don't know your team, can you tell us a bit about yourself and the team before we get going?
Sure. We invest at the earliest stages, seed and Series A, in startups, and we invest across 3 broad areas: enterprise software, fintech, and crypto investing. I spend all my time on the enterprise side, and as you know, Chris, and many of I'm sure our listeners know, I focus on cybersecurity and IT infrastructure investments. So very much connected to where you and I spend time, where most of the listeners who are joining us spend time.
Yeah, that's what's exciting about chatting with you is like you get to meet with some of the innovative teams that are kind of building the future of this field essentially. So I wanted to start there. 1 year in, like we talked last year around this time, and last time you were on, you walked us through how Foundation Capital finds and backs early stage cyber IT founders and so on. A year later, with everything that's moved in terms of AI, agentic AI, LLMs, all the things, where are you actually writing checks today, and what's changed in the past year or so?
Well, the firm's been around now for over 30 years. I don't think a lot has changed is the real answer in terms of how we invest, which is that our focus is investing at that formation stage. We're either the first or the second institutional investor, and 80% of the time, we're the first investor. And we come in when the companies are just getting started. So that aspect hasn't changed. I think, as you described very rightly so, what has truly changed is actually, the fact that technology is ever changing, and as technology has changed, we've had to adapt, and certainly over the past 2-3 years, we have seen a massive kind of increase of usage of these large language models for different use cases for these different use cases. And I think that's been the most exciting part. And I think AI is permeating across multiple different segments of our market. In enterprise, we're seeing changes in application and middleware and in infrastructure, and certainly now we're seeing some of the use cases for both fintech and crypto as well.
Yeah, it's definitely a lot. A lot has changed. Of course, like the fundamentals are still the fundamentals, but it feels like every company has an angle. All the startups I see, like, have an angle around AI, agentic AI, whether it's, leveraging it for security, looking to secure its usage, a combination thereof, make things more efficient, more effective, et cetera. And a big thesis, like, around this time last year too, was like this concept of services as a software, like the ability to use AI to, go after labor and services, and the TAM, right? That, is associated with that, often knowing that a lot of the cybersecurity spend is not necessarily on products, but on services as well. And it's historically kind of been outside of software's reach. And we're now seeing like, different categories, whether it's AI SOC, and I see it in AppSec, SecOps, GRC, you name it, offensive security. It's kind of touching all the things in terms of going after services in addition to the software itself. Is that playing out the way you expected? And I know you've wrote and spoke about this before. Where is that reality kind of diverging from the pitch, and how's it evolving?
I think it is in many ways it's playing out the way we expected, and you pointed it out well. 2 of my colleagues pushed a big post on services software quite a few years ago now, and highlighting that this was going to be a $4.6 trillion market, and certainly that has kind of continue to play out. I think the biggest change we've seen in cybersecurity, you mentioned AI SOC. If you remember this a year ago, we talked about AI MDR with Air MDR, and the managed service aspect of MDR and how that will change with humans plus AI agents. And certainly, we have seen that. And I think that aspect has been pretty interesting to kind of witness. One of the things that we spend a lot of time trying to think about is where the other aspects of services software being applicable. And one of the things that I mentioned to you last year that I've been spending time on is what are the different workflows in cybersecurity and how do we go about automating portions of that workflow. So every time we think about different tasks and different teams within cybersecurity, what are the aspects of those jobs that can be automated? So whether that's product security, whether that's, as you mentioned, detection and response with the SOC, whether that's incident response, whether that's pen testing, threat intel, yeah, security strategy. There are each of these areas where we will see services software being implemented. And we've seen a combination, which is external services. So services from, MSPs, MSSPs, large consulting firms, and seeing how we use agents to automate portions of that work, but also internal workflow. So, when you have employees, what portion of those jobs and tasks can be automated? I think the biggest debate probably in the past year has been, does this strike the end of many jobs, particularly white collar jobs? And certainly, the number of layoffs that have been happening have only increased in the past year since you and I were on, and I think that is causing a lot of heightened risk. I don't worry that long term people will lose, kind of the ability to work. I think the jobs themselves will change. And so the biggest thing for each of us is how do we adapt? How do we use these new tools in an effective manner? There's been, kind of a big learning from that in terms of, kind of where do we, see new innovation, pockets of innovation. I think people are trying to adapt to these new changing roles. And at Foundation, we've been pushing to, get more and more folks to use these tools more effectively for their own work, whether that's been, scheduling a new calendar invite, which is certainly what many of our EAs spend a lot of time thinking about, all the way to, how do we write more effective memos. So I think, that aspect is something that, we spend a lot of time thinking about.
Yeah, I've been advocating for folks in cybersecurity, as well, like leverage into these tools as much as you can, right? In your own daily workflows, how you do research, how you think about things, how you put together, presentations, materials, artifacts, all the kind of things, coding, et cetera, design. It's kind of touching everything. And when you were talking about the services thing, it made me think of a question. I know this isn't necessarily like your guys' core focus, but like I've seen this trend among the labs, right, where they're kind of spinning off these billion-dollar subsidiaries or like new business entities to kind of put forward deployed engineers, right? Like even the hyperscalers, I think AWS made a massive announcement around this like a week or two ago. When you look at that as part of the AI, digital transformation, the rollout of AI and so on that's going on, what do you make of that? Like these massive investments in terms of trying to kind of entrench, embed, and kind of implement AI. What do you think of that when you look at that trend?
You know, I think we're still early days and kind of seeing, pockets of innovation and, where is their opportunity. Um, I don't worry too much about kind of, how things will change here. And I think that there's an aspect that, kind of, we have to all adapt to things. So yeah, that's, it's kind of a learning in itself.
That makes sense. So last time, since we spoke, a lot has happened in the M&A space, both obviously like small, but also massive acquisitions. Like since we last spoke,
Yeah.
Palo Alto had closed, a $25 billion acquisition of CyberArk, very identity centric type major play. There's Alphabet finalizing their $32 billion acquisition of Wiz. You've posted about consolidation a bit, I think, in some sense with big players like ServiceNow expanding its security platform through acquisition. You've also argued, though, that a handful of players will never fully kind of dominate cyber because of how many niches and categories and sub domains there are within cyber. How do you kind of square that platformization push that we're seeing kind of play out in some ways, but also the best of breed that is always there, always innovating, always bringing new capabilities to the market at the same time?
I think this is the quintessential question that keeps coming back again and again. And I think that when They will this debate will happen and has continued to happen since the kind of the dawn of cybersecurity or broadly IT infrastructure as a whole. I think I don't expect a world where best of breed goes away, even with LLMs, even with AI agents, even with the fact that whoever has the most data will be most likely dominant in this space. So I don't look at it and worry about that. That being said, I think the biggest change that's happened in the past year, and you mentioned, kind of ServiceNow with both Vesa and Armis. At the same time, we had Palo Alto buying Chronosphere end of last year. Is this view that folks who have predominantly targeted the IT, kind of customer base, so the CIO and the head of cloud operations and head of infrastructure, are now also adding in cybersecurity. And ServiceNow is an excellent example of that. I mean, when they did the combination acquisition of Armis and Vesa late last year, they really made a push for cybersecurity and why they care about that category. At the same time, you saw Palo Alto Networks buy Chronosphere after buying CyberArk in a very, very heavy year. And as they highlighted this point, they noted the advantages of focusing on observability more broadly. And what they're showing is, just like ServiceNow is entering the security kind of business, they are also entering the IT infra business, and we're certainly seeing more and more of that. I mean, just this year we had Databricks announce LakeWatch, and then subsequently buy Panther. I mean, that's a very big focus on cybersecurity. SailPoint, which we would argue is more of an IT oriented or an identity oriented company, has gone and acquired Entro to be more actively on the cybersecurity side. So we're seeing this kind of amalgamation of the CIO and the CISO buyer, and we're also seeing that certainly happen with the customer base. There are more and more, CISOs who now play the role of CIO and kind of have that joint role. So I think that this is probably the biggest change that we have seen in the past year. I think the debate on best of breed versus platform will continue. As you highlighted, on the view that best of breed won't die, but there's some people who believe that may change.
Yeah, I definitely think it's several interesting things there. You said like the convergence where it's bi-directional too. Like some of the IT players are moving into security, some of the security players are moving into IT. Both of them obviously are looking at this from a market expansion perspective, bringing more consolidated capabilities to bear. And honestly, like you see it in the workforce, like you talked about, there's the most famous example in my mind is Equifax, where you have Jamil like moving from CISO to CIO, I believe it is, or CTO. But nonetheless,
CTO,
like
yep.
yeah, moving into the obviously like the broader IT space beyond just cyber, and then that age-old debate is going to go on forever. There's always going to be innovative startups that kind of cover niche capabilities that the incumbents can't move fast enough to capture or build out, and then they're obviously going to get absorbed in some way in platforms a lot of times, and it's never going to end. I don't think there's no end in sight for that per se. I also wanted to ask you about valuations, like maybe just talking about even AI SOC as an example, not to pick on that category or the players in it, but when you look at it, like 7AI, for example, raised like the largest series cyber A on record. Torque, crossed $1 billion valuation. Exaforce, raised a massive raise in the same category. Like you sit pretty close to the revenue and the founders and the funding and so on. Like, do you think these valuations are grounded in like what customers are actually paying, or is it some of it the market kind of pricing a story ahead of the numbers in a sense?
Oh, it's certainly a market pricing a story well ahead of numbers, and I think that those are always dangerous games. The reason that this market is pricing the story is that when you look at areas outside of cyber, for example, if we targeted code gen or we looked at some of the new AI apps that are coming, the pace of growth, the pace from 0 to 100 million of ARR or a billion of ARR or multiple billions of ARR has increased so dramatically in these other categories that the view is that maybe this will happen in cybersecurity and other sectors as well. And so the market, and particularly investors who invest across a broader landscape of kind of areas, they are starting to believe that, hey, this will be possible here in cybersecurity. And they are certainly investing well ahead of metrics. I think there are complexities in cyber that make it much harder for us to see that level of astronomical growth. principle of which is obviously the fact that we are, in an industry that focuses on reducing risk. And so we are automatically targeting a customer base that is very risk averse. And so wants to get all the boxes checked before they go and purchase these solutions. This is very different to a developer looking for a new code gen tool to, automate a portion of their development. So I think that aspect will make, kind of the level of growth that we have seen in other categories harder here. And there is risk that investors are taking when they, put in these large valuations. And unfortunately for, all of these good companies, if we went a few years, ago, we would see several unicorns that were invested in during that 2021 and 2022 time period. So the ZERP era, the zero interest rate policy era, when money was relatively cheap and a lot of new unicorns were being birthed. When you look at those unicorns today, 3, 4 years on, you're already seeing several of them being acquired for a significantly smaller, kind of end result than even the amount of capital that went into those companies. Forget about let alone the valuation. So there is risk when founders take this level of kind of these valuations and these astronomical goals. And my only caution to founders would be to think about it. For investors, this is one investment that they make in a portfolio, and if they're wrong, it's certainly not great, but it's one of 10, one of 20, one of 50 in a fund. But for a founder, it is one of one. So it's really thinking about, do I feel like this is what I would value the company? Do I feel that this is something that I can grow to in the next year? And if the answer is no, then my recommendation has always been, and I say this to my own founders, really think about, do you want to take this valuation? I've, increasingly spent more time cautioning my founders from taking higher valuations, certainly in the past year.
Yeah, actually, I want to double down on a couple of things you said there, if you don't mind, because a lot of my audience, obviously there's founders, investors, and things like that, but a lot of cybersecurity practitioners and folks thinking about starting companies, things like that. Two things you said there. One is like you invest in the seed stage, like earliest stage startups. Is your risk calculus a bit different than some of the later stage investors and how they think about, the path to liquidity or successful exits and acquisitions, et cetera? Like, what does that look like from your perspective when you look at the valuations? And like you said, some people are being bought for even less than they raised altogether. Like, what does that look like for you?
Yeah, it's a great question, Chris. For us, we are investing so early that we don't even, you can't even imagine what the end exit value of the company will be. And for us, our hope is that that end exit value will look very exciting. And even when a company goes public, we remain large shareholders. A great example of that, we've been very fortunate. One of our companies, Cerebrus, which was incubated in our offices by my partner Steve, that went public earlier this year. It was one of the kind of the cornerstone AI IPOs, and that company is trading at that 50 billion valuation. I don't think that Steve, when he made that investment in 2016, that his goal was, to value the company at that number. I don't think that, even the none of us could imagine, what that company could grow to. Certainly, we had big ambitions, and the founders had big ambitions that if this works, this can be a massive, opportunity and a critical company. But that, is very hard to determine, at the time that we make an investment. So at time that we make an investment, our primary goal is to go and figure out what is the current, broader valuation in the seed market, and how do we kind of make sure that our founders don't feel like we got some special deal, that we are, right down the fairway. And then I think that the second most important thing that I think about is, okay, what is the Series A, which is the absolute next round that happens right after? What's the Series A going rate right now? And how do we make sure that we price the seed round in such a way that, when we meet the milestone for what is expected for that Series A round, and those milestones change, roughly every year or so. But do we think that that new valuation that the Series A goes at, we will have enough of a step up between the seed and the Series A that the founders, the employees, the investors will all feel excited about the business? And typically that ends up being, you want to see a step up that's 3 to 4x between seed and Series A. And those are the two ways to try to figure out how we think about valuation.
Yeah, that's excellent insight. I was just wondering that from your perspective. And then the other thing was you caution against, for founders, right? Like in terms of the level of funding that they raise or accept, and then the valuations they accept. Like, what are the practical, the realistic implications of that? Because when you look on social media, all these valuations are like congratulatory and celebratory, and like the bigger the number, the more exciting. But like, what is there's a double-edged sword to that, as you said, like cautioning that, like what could it mean if you don't grow into that valuation, or it doesn't go the way you want it to go? Like, what does that truly mean for the founder, the team, those kind of things? What does that mean?
I think the two things that I think about in that aspect is one, the dollars that come into your company. And whenever you raise a lot more dollars than what's expected of you, as much as you don't want to spend money, I've so many times founders tell me, "Oh, I'm raising this extra money, but I won't be, spending it. I plan to just, pack it away in a side, kind of bank account, and I won't touch it." The issue is that the investor who's giving you that money is expecting you to spend it to grow faster. So, that's not going to work for the new investor. That group will start to push you to say, "Hey, we gave you more money than what's in the market and what your peers have, that means you should be growing faster. You should not be, kind of continuing to grow as is." Let's say the investor is also open to you, kind of not spending all that money immediately and not growing crazy, which would be very weird, but let's just imagine that scenario. Well, every time you interview an employee, you interview a partner, you interview a service-oriented, vendor that you're working with, they know how much you've raised. It's all public information. So, if you raised $100 million Series A round versus the average Series A is 15 to 20 million, they're going to also expect that you're willing to pay a lot more money. And so, I see this all the time. Developers are asking more, sales leaders are asking more, AEs are asking more, product marketers are asking more, your, recruiter is asking more, the person who creates your pitch decks is asking more, your events marketing outsourced team is asking more. They want you to do more events. Suddenly you end up spending a lot more. I mean, that is a very difficult situation. And it isn't something that you are planning to do, but it's suddenly the going rate changes because you have more money. So that's one aspect, which is the actual dollars that come to you. The second aspect is the value of the company, the dollars assigned, so the total valuation. And there the complexity is really that, as you have a higher valuation, more is expected. The end outcome also needs to change. What the potential buyer, if you end up targeting an M&A, or what the IPO markets are looking for, also changes. But the person, who's looking at you from an exit scenario, or the next investor, won't just look at that valuation number. They'll also be looking at revenue. And if revenue isn't growing and isn't keeping up with that, higher valuation, then they start to argue, hey, maybe this isn't worth what it was assigned last time around. And one of the easiest unfortunate ways to destroy a company is to have a down round. It really kills multiple things. Firstly, your employees see the value of their stock go down, and that really stresses them. Secondly, your customers hear about this down round, and then they start to question, hey, maybe this company isn't in a good footing. Thirdly, obviously, you are personally impacted by dilution as a founder, and as a result, your motivations change. You start to strike more for a crazy outcome because you say, oh, I own a lot less than what I should because of this crazy down round that happened. And then your existing investors, who typically are also impacted, a subset of them, maybe they didn't invest in that down round, they start to be very difficult and combative. So all these things start to play out, and it just many times people only think about it after the fact. I'm sure you've watched Silicon Valley, the TV show. They had a great clip about, you could raise less. Like, no one told me I could raise less. There's this, situation where Richard meets with a founder and he asks them, hey, what if you just raised a little less money? And that founder starts to think about it and realize, oh my God, actually, my company wouldn't have failed if that happened. Like, nobody told me I could do it. And that's such an important
Yeah, that's
aspect.
why I wanted to ask. It's like a great distinction or something that people don't often think about or talk about. And I actually wanted to ask one more question on this topic before we move on. You made that kind of there's an implication, right, to spend the money to grow. You used the word to grow, but there's a big distinction, as you point out, between growing salaries, growing headcount, growing product marketing, marketing events, all these kind of things, engineering talent, capacity, et cetera, and growing revenue. Like you can't, and you talked about this earlier, like cybersecurity is a bit of a unique market in the way that the buyers behave and the implicit level of trust that's involved in procurement decisions and things like that. You can't necessarily spend your way to growth per se. You can in some ways, but it's not just throw more money at it, right? It's not. There's more complicated than that. So can you unpack that distinction of like, there, you have more capital, you have more money to spend, but it's not simply just throw more money at it. Like it's not necessarily how it works in terms of growth. And the growth doesn't necessarily mean headcount and salaries. It means they want you to grow more market share, more revenue, more customer base, et cetera. Like, how do you think of that?
It's 100% true, Chris. I mean, that's the most important fact, that, just growing, having more social media presence, getting more likes in your posts, having more followers, getting more events, going to speak at more conferences, none of that matters. Like, the investors, unfortunately, at a certain stage, like, it doesn't matter. Certainly, it doesn't matter if you want to take your company public. The public market investors don't care at all about it. What they care about is revenue, and they care about customers, and they care about low churn, and they care about high NDR. I mean, those are all the things that matter. And, you know, yes, could they be influenced by the number of, followers you have on LinkedIn? Maybe. I mean, maybe that'll increase the number of customers who are looking and hearing about you. But is it just because somebody reads your post that they end up becoming a valuable customer and somebody who believes in you? Probably not. I mean, probably they care a lot about your product. They care a lot about the execution. They care a lot about the pricing. They care a lot about the end result and what it does for them, how it adds value to their goals. And those are very different things that matter. So product market fit, and figuring out when you have product market fit before you go and spend all that money to do all those other things is so critical. And I think many founders, they think that, oh, I'll just spend all this money and the product market fit will come. And unfortunately, that I wish that were true, because it would make our lives a lot easier. I mean, we could just give the money and say, go and spend it in these 6 areas and this will work. But
Yeah.
unfortunately, it doesn't work that way.
Yeah, exactly. It's much more nuanced and complicated than that, and it's not just throw more money at. That's why I wanted to pause and kind of dig in on that one. I also want to ask you. There's, of course, a lot of conversations going on about the moat, right? Or what is a moat anymore? What's defensible? Things like that. There's a lot of conversations around a model can copy your roadmap, or even the frontier labs themselves could push into your category, as we saw with native security offerings or design offerings and things like that, even beyond cyber. Like through CyberSeed, you talk to a lot of early and aspiring founders. Like the hard question, of course, is like, what is the moat? If the frontier model can release, or replicate a chunk of your product overnight or quickly, given their size, their capacity, their distribution, et cetera. Like, what are you actually underwriting in a founder in a company today, and what no longer counts as being defensible? Maybe that used to be defensible, or more so defensible, I guess I'd say.
I think there are parts of moats that are, that I believe will be enduring, at least for the moment, and there are parts that are starting to feel like they don't have as much of a long-term, viable path anymore. I think, there are obvious areas. Proprietary data, massive moat. And the more proprietary data you have that it hasn't been released to the foundation model companies, the more value you can attain. And I think that that's a really deep understanding. We've pushed at Foundation. We've talked a lot about context, having deep understanding of the workflow, having deep understanding of specific human-based decisions, of exceptions that are made. That context ends up being really, really important. Connected to context, having integration depth. Having this integration across a whole bunch of both external applications as well as internal apps and internal tools that have been created, which is all connected to this context aspect. Big moat today. Could that change that part, the integration part? Could it change over time? Potentially. But there's a lot of internal apps that are much harder to go and have the integration necessary. Speed of distribution, speed of innovation, speed of pushing out new product and updates. I believe that that will remain a moat. That is something you have to constantly change. You have to constantly be willing to kind of be at that cutting edge. But if you maintain that culture, I do believe you will have kind of a longer term moat. I think areas that are hotter, UI, which used to be a huge area of focus for the last 4 or 5 years. I mean, if we look at companies like Wiz, it was all about creative design and UI. I think that is less of a moat today. And that's because we can use these models to go and build simplistic design, build, futuristic product, given that nice user experience. And by the way that we are interacting with applications is changing. Last, decade, the focus has always been you and I click a bunch of buttons and then things happen. Now it's us speaking to a system of agents and things happen. And now it doesn't matter where the buttons are. We're able to just go type stuff in and things happen. And so that UI aspect is becoming less and less of an area of focus.
Yeah, great answer. The last piece you touched on, like the UI UX, there's been a trend of kind of quote unquote headless, as they call it. Like some software companies are going that direction. We've even seen some cyber companies starting to kind of move that direction. And then you start off about the proprietary data aspect. There was a very viral rant now by one of the largest, I guess you'd say like defense tech companies that are out there that's went viral about the moat and your proprietary data and all these things, and Frontier Labs pushing into it, and that's kind of spurred a lot of interesting conversation around open source versus closed source AI and all things therein. So definitely, folks, check that out. Before we jump to like the last 10 minutes or so talking about Black Hat and so on, I wanted to ask you, another thing is that deal flow is kind of at all-time high prices, I think, in some ways, like seed and Series A valuations, which you talked about a little bit, are at or near record highs in many cases. But the capital is also concentrating into maybe a few hundred deals per year. Like as an early stage investor, how do you stay disciplined and non-consensus when the best rounds are this competitive and this expensive? Are you walking away from deals that you would have done maybe a couple of years ago? How do you look at that?
It's a great question. It's something we think about all the time. And you know this well, and I spoke about it earlier in this conversation, that our focus at Foundation is to back investors at inception stage and be that first investor. And we're typically investing as a result at the seed or Series A. And I think the big change that has happened is the concept of a seed and Series A is evolving. You mentioned these crazy Series A rounds that are happening. What used to be normal is no longer normal. And I think that we are having to adapt to. We try to focus on discipline, and that is around what are we good at? What are we the best at? We certainly believe that we are very good at incubating. We're very good at inception stage. That's something that we care deeply about and we enjoy doing. And so our goal has always been finding the best founders who are going after cutting edge areas within, whether that's cybersecurity or other categories, and really helping them, brainstorming with them to go and come up with the ideas for what hopefully will be generational companies. So that aspect is slightly different. We are not going out there for the most part and chasing rounds that 12 other VCs are also putting term sheets for, and we are now the 13th term sheet in there, and then it all becomes about who has the most interesting price in the loosest terms. For us, it's really about trying to go and sit down with founders well before the idea has been created and brainstorm with them on a whiteboard what that idea could look like. And whether that's Cerebrus, and certainly that's been a fun journey to talk about for the past 2 months, because everybody is now spending time thinking about that company. But it's also companies, you and I talked about RMDR and in our last session. It's companies like Aegis AI and email security, and Prime and product security, and Stacklet in cloud and AI governance. Those are the types of kind of early conversations. All of those companies we invested at the inception stage. All of them we sat down when it was just the founders, and we spent the time brainstorming with them what would hopefully become an interesting idea. And then our aspect is around, our focus is around how do we make that from an idea into reality and into a product that, to your point, customers want. Not just where we get the most marketing, but ones where there is a product market fit, where there is a value point that we're meeting for the customer. So I think that's been the aspect here, is just how do we kind of ensure that we are playing in the field that we feel strongest in, and that we don't get, kind of overexcited when other things start happening. At the same time, we're certainly trying to look and say, okay, well, what are the areas? Are there certain next generation foundation model companies, maybe they're focused on physical AI, that we should be thinking about? Are there great researchers coming out of Stanford or MIT or Berkeley that we should be thinking, and spending more time with? How do we kind of go and have those relationships and figure out how to work with those folks, and figure out how to work with those folks in our own constraints and our own goals of what we think is a normal, kind of interesting company.
Yeah, I love that answer because as you're kind of speaking to it, it's much more complicated than just throwing money at it. Like there's a lot that goes into that. And honestly, I've spoke to several of the teams you mentioned, Aegis and Prime and so on, and the founders are incredibly passionate about their problem spaces. They've often lived the problems firsthand or helped build previous generations of solutions, in prior technological waves, and all that kind of compounds to give them a bigger opportunity, right, to go and tackle that problem and provide a new innovative solution, which of course, as we talked about, becomes a best of breed offering in the market. So, last aspect of the conversation I want to talk to you about is Black Hat. Like I know you're heavily involved in different aspects of Black Hat, different events. Of course, the big one that you and I have been talking a lot about is the Innovator Investor Summit. For folks not familiar with it, can you tell us a bit about it? What should they anticipate? Those kind of things. Who should attend?
Yeah, great question. So the Innovators and Investors Summit was started a couple of years ago, and it's really focused on cybersecurity founders and startup execs. It also has several venture investors, and broadly even some of the later growth stage and private equity investors join, as well as corporate buyers. And the target is, what is happening on emerging technology? What are some of the areas that founders are thinking about? What are the next generation of products that could be relevant? And every year, the Black Hat team, I know this year you're MC, I'm very excited to see you on stage, but the team spends a lot of time trying to go and curate some of the best speakers. I still remember a couple of years ago, to his credit, George Kurtz coming up on stage, and this was weeks into one of the largest, complexities in cybersecurity, which was the CrowdStrike summer incident that completely, put cybersecurity as front and center for all of us. But George came up on stage and talked a little bit about how CrowdStrike was formed, and what were the areas that they focused on. Where's innovation? And he did that 2.5 weeks after that incident. And I think he did it in many ways because he really believes in founders. He wanted to get up on stage, and still be in front of people, despite the complexities that the business was going through. And so I think there's that level of passion to say, hey, where's innovation? What's the cutting edge of innovation? And I'm very excited to kind of see the summit play out another fantastic year. And I think for those of your listeners who are excited about innovation and are thinking about either starting a company or have started a company or work at a startup or are investing in startups, or just broadly are thinking about the landscape, fantastic one day to spend during Black Hat. The great part is it's just the day. We have a great number of sessions. I know we'll talk about Startup Spotlight. We have that session happen, of course. And then there's also these breakout sessions where you can go and meet people who are in the audience. I think it's a very unique product that's been created.
Yeah, it's super cool. I'm excited to MC it. Like, obviously, I'm filling some big shoes from Mike Prevet and others who have done it prior. But it's an incredible opportunity to bring together, as you said, investors, founders, people innovating, building the future of the kind of domain in cybersecurity, especially at this time of AI. I did want to make a note. Black Hat is actually willing to, offer these listeners, folks of the show, $500 off the registration if you use the code USA 500 Resilient, USA 500 Resilient. So check that out. And then the last piece you talked about was the Startup Spotlight competition. Tell us a bit about that. Like, how is that shaping up this year? What can folks look for?
It is, every year the field gets more and more competitive, and we had a fantastic group of startups that, as judges, we had to evaluate. And I can tell you, Chris, it's always a debate. Every time we sit there and we think it's going to take us 25 minutes, and it ends up taking us 2 hours as we debate, which founders deserve the stage. And that's not because we have a strong number of disputes within us. It's more that we actually feel that more founders deserve the stage than obviously we can provide. And what ends up happening is that as judges, we go and evaluate these submissions that come in from founders, and we watch these 5-minute videos where founders share what they're building. They provide a product demo. They talk about the customers. They talk about the competitive landscape, and then post that, we have to go and rank each of these founders and companies, and then we debate internally, and usually the scores end up being very tight, and we come and we have to ultimately pick four companies that get to present, and we just announced the four. So we're very excited for them to go up on stage and talk about their journeys, and hopefully our goal is that they end up having a great kind of 5 minutes of fame in front of a very large stage, which is also recorded. And then our goal is to go and pick one winner. I think the biggest change that's happened this year is whoever wins what is now called Black Hat USA Startup Spotlight will later that day go and speak on the main stage of Black Hat. So the biggest stage at Black Hat, they will speak in front of a different set of judges, and I'm excited to be there for that one as well, and kind of compete for a global award. So we have picked. There have been three other startups that have already been chosen for the three other regions that Black Hat operates in. So they won the startup spotlight for those regions, and they will join in with with the Black Hat USA winner to go and basically compete for the crown of global startup spotlight champion. So I think that's a big change. I'm excited to see how that plays out. I obviously will try not to be biased towards the USA winner, given we are both in the US. But I'm very excited about that session as well.
Yeah, I think it's super cool. It's kind of like the World Cup or the Olympics of
Exactly.
cybersecurity startups. So it's a super cool thing that they're doing there. But Sid, thanks so much for jumping on. Sorry about the technical difficulties in the beginning, but we got it done, covering everything from valuations, deal sizes, founders, how much they raise, all in there in between. So thanks so much for jumping on, man. I look forward to chatting with you in a few weeks in Las Vegas.
Thanks so much, Chris. Thanks for having me on, and thanks for doing all the amazing work you do. I mean, it's so much fun to read, to listen in and think about all of the work you are spending time. I think for your listeners, just the amount of information that Chris is able to consume is, in my mind, I have not seen many others be able to do that. So huge kudos to you for dissecting all that information, allowing us not to go and read 500 articles and instead just summarizing it for us so that we can we can just read your posts instead.
Awesome. I appreciate it. Thanks so much, man. I look forward to talking to you soon.
Thanks so much.
All right. Bye bye.